My name's Adam Pugh. I'm with the law firm of Cagle Pugh. I've been serving primarily homeowners associations for the better part of the last 20 years. And I'm here today to answer some questions about insurance.
My name is Jeremy Day. I've been an insurance agent for associations. That's our only kind of stick, what we do. And I've been doing that for just over 8 years now.
Thank you, gentlemen. So let's go ahead and get started. So we want to kind of go first into the purpose of this workshop and this meeting is to kind of discuss association insurance exposures, both on the vendor side and the association side. When it comes to HOAs and condominium, the board has a very big role in protecting the association's financial and physical assets, and this plays right into that. So we're going to kind of lead with first going through some questions, because I know that we all have this. The big question this year is, how is the current state of the insurance market? Jeremy?
So currently the market is actually leveling off. So over the past few years, we've seen an increase in rates over many of the states, especially states that have high loss histories, Texas, California, Colorado, and a lot of the coastal states. What we're seeing though is a lot of carriers have pulled out of the market and they're actually starting to come back into the market. There's new competitors, new insurance carriers that are attempting to start writing in areas that have been largely difficult to write in. And so now we're seeing the market either level off, and in some cases, some insurance rates are going down. But we are seeing some new trends on the homeowners association side, the single family side, where we actually see inflation guard coming into play. And so we're seeing some increases on that because of that. But for the most part, the market is not going to be going up as rapidly as we've been seeing it the last few years.
Well, that's really good news. So for the association, and we're just trying to set the stage for what we're going to be discussing. We talked a little bit earlier about what associations should carry as far as insurance, minimally, and the ideal scenario. Can you go over that for me, please?
Yeah, so at a minimum, every insurance or every community should be carrying at least general liability and directors and officers. One, general liability is going to be covering, it's a broad spectrum, so it's just going to protect the association from numerous types of claims. And the directors and officers is going to protect the volunteers that actually do the work for the association, those board members, those committee members, even your property management companies. So those are going to be the two that you must have or you should have. But the six that we see, commonly are property, general liability, directors and officers, crime fidelity, which is going to protect your bank accounts, umbrella or excess liability, which just goes over your general liability and in some cases extends over the directors and officers and just extends those limits. And then your workers' comp. In our workers' comp, we're going to talk a little bit about that, but it's one of those that is not a true workers' comp that you may see with your current companies. What they are is a ghost policy. So they really just protect the association from other people coming on, because we know the association doesn't really have employees, and we can't have employee codes to write true workers' comp. This is more just for the what ifs out there.
Okay, thank you. And that's kind of what we want to touch on too, is what's out there if we aren't adequately covered. So when we talk about insurance coverage for the association, we have to bring in the conversation. Well, so if the association is adequately covered and we bring a vendor on property who's inadequately covered, what risks are there? And Adam, I'm going to go ahead and direct this to you. What risks are being created by having inadequately covered vendors?
Sure. So what we really want to see is vendors that come on to association property and do work for associations that have the wherewithal to both back up the work that they're doing and any claims that their employees might make against them. So what I'm really getting at is as you've indicated, mom and pop companies, they might be the best price, they might be the lowest cost. But if they don't have sufficient insurance, and for example, they come to fix the roof and somebody falls off the roof while they're working for this independent contractor mom and pop company, there is the potential for that employee to then make a workers' comp type claim against the association if the if the actual employer doesn't have sufficient insurance. And so that's one of the things that I know that the management company will do is vet these vendors before they come on the property, and always require things like a W-9 and a certificate of insurance naming the association as an additional insured. That way we know that the association will have coverage in the event that something like that were to happen. And we don't have to be looking to our own insurance policy or our own assets to cover claims that should have been covered by the vendor in the first place.
Thank you. Okay, so that's I guess the big question, right? How do we avoid this? How do we protect the association from these liabilities? And so that's what we're going to kind of unpack a little bit now. So general liability and D&O. So let's say at the core, all associations have at least that. So we have general liability. D&O, how does D&O help us with protection from inadequate vendors? Jeremy, can you speak to that?
Well, it really speaks to the decisions made by the board. Okay, so when they are choosing the vendors that are coming on, and this may be maybe counterintuitive, or maybe in contradiction to what the management companies may be suggesting, or who they're suggesting do the work. These boards may say, hey, our responsibility is to find the best, cheapest, or whatever options for this. And so they may make a decision that other people are advising them against. And that decision would be protected by the directors and officers as long as they're following the governing documents and their guidelines within their decision making with votes and elections and so on. But that's where that would come into play, is the decisions to hire these maybe inadequately covered mom and pop, or even sometimes they're bigger companies that just don't carry insurance. It's a cost that they don't want to carry.
So let's say that we find the association's a vendor that does have insurance, right? Just having insurance isn't enough. So let's say that they do say that they have workman's comp, and we review their COI. What is a red flag for us in their workman's compensation coverage as far as the vendor is concerned?
Well, I would, look at the limits. They should at least carry $1 million limits on the workers' comp. That should be the first red flag. The second thing is to make sure that you look at the expiration and dates that are on there. I will say that we've had some vendors in the past that have actually taken old certificates of insurance and used different PDF or other digital ways of doctoring those to make it look like they carry insurance. So asking them to have your company made as a named insured, or your association made as a named insured, and getting a copy of that from the insurance agent or insurance carrier with you as that additional insured in the named insured box down at the bottom. They may put it in the notes as you as an additional insured, not a named insured. That's a totally different thing. An additional insured. Once you have that done and that's coming back from the insurance agent or insurance carrier directly, then you know that policy is in place. Okay. But if you're just getting somebody who's doctoring it up, maybe from the insurance company or from the company that you're hiring it from, unless you know and will work with that company for a long time, it may be a red flag that they could possibly be doctoring it up. Not everybody will, not everybody's dishonest in this world, but there are some companies that maybe couldn't get insurance or didn't have the funds to pay for their insurance premiums, and they had something lapse, or they're in the process of getting it renewed, or maybe that's in your contract talks. So you just want to make sure that you have, proof that it's actually in place.
Got it. So the vetting process is extremely important. You made a mention of the additional insured versus the named insured. What's the difference between
So
the
a
two?
named insured is, so on an association's general liability policy, they're going to be the named insured. We're not going to name every homeowner that lives in the association as a named insured, but they may have their mortgage company as an additional insured. The difference really is that an additional insured has access to some of the payouts, has a claim to the property or the liability that might be there, and they have protection under that coverages. A named insured is somebody that is actually can cancel coverage, could actually file claims, could actually do things on the policy that the actual named insured could also do. So it's essentially the same as like, hey, I have a insurance policy under my name. I add my wife onto there, and she is a named insured as well. So she can access the policy documents. She can cancel the coverage. She can make payments. She can do the claims, whereas an additional insured could not do all those things. They're afforded the protection that those policies provide, but they can't do anything to those coverages or those policies.
Thank you for clarifying that, Jeremy. So while we're still on the topic of coverages, so as a vendor, when the association is vetting and we say, hey, we've selected this vendor to maintain the association's landscape, pool, whatever the case is, what are we looking for? What is adequate insurance?
Well, I mean, I know, yeah. So the first thing the two things that I would see is general liability. It's going to have commercial general liability because it has built-in safeguards and different limits, and then workers' comp up to $1 million. Those are the two main ones that I would have. Anything outside of that would be maybe particular to the company, property that they insure their equipment, or crime fidelity that they might protect their bank accounts, etc. But that the two that are most pertinent to the association would be general liability and workers' comp, unless I'm missing something there, Adam.
And I certainly agree with Jeremy. Those are great rules of thumb to follow. But asking the question, what is adequate insurance, comes with a lot of caveats. And so if, for example, you are a large condominium, high-rise condo that's getting a large project done that's, in the $10 million range, $1 million of commercial general liability insurance may not be enough. And you might want to make sure that the amount of coverage is at least as much as the amount of your contract. And again, if a vendor has $1 million policy for commercial general liability or workers' comp, and then, for example, let's talk about the high-rise condo community. They send up a window cleaning crew with 10 personnel on one of those lifts that's held by 2 ropes on either side. I don't want to get into what I think could potentially happen there, but it could certainly be worse than $1 million. So all I would say is that while $1 million is a great floor to have, it might certainly not be the ceiling that you need based on the specific project or task that these vendors are going to undertake on your behalf.
Yeah, and just to add on to that, what I was speaking more towards is like when you're asking those mom and pops that are typically coming on to do, little projects around the community. When you're talking those big ones, we're going to get into the scope. And what you should look for on the certificate of insurance is probably going to be an excess liability or an umbrella coverage. That's where it's going to increase those limits. They're not going to have a general liability that's going to have a $5 million general liability. Almost every commercial policy out there is going to start at $1 million. How they get that is they're going to get an excess liability policy or an umbrella policy, which will be listed separately. So that may take some scouring on the certificate of insurance. You might need copies of the policy, etc., especially if you're getting into the 10, 20, $30 million range when you're getting into these big projects. They may have to carry a lot of coverage. And if you're getting into those big projects, I would not go with a mom and pop shop. I would be going with a very reputable company that does have that insurance. Period.
That's exactly correct. As a management company, we definitely encourage reputable vendors, but we also acknowledge the very real situations that we deal with, which is some associations do come with preferred vendors that have been working or serving the community for years. And while they are efficient and they do a great job, they're just not big enough to support the insurance expectations that are being put upon them by the association and the management company. And so one of the solutions that I've seen put in place to try to help resolve some of that are waivers. And I wanted to kind of go over the different types of waivers that we've encountered in the HOA world. You have the owner waivers, for example, when you have a bounce house. That was an example that we talked about before, Jeremy. a bounce house in a community, and you're doing a community event, if the association is sponsoring that event, there's usually an owner waiver, vendor waivers, as well as when you have some associations are so big, they have the clubhouses and they have camps. And those camps, there are individual vendors or individual businesses. And so there's waivers there as well, between the vendor, the participants, and the association, along with waivers that are presented to the association by the management company if they do insist on using a vendor that is not adequately insured on their property. So can we kind of flush out what these waivers really do? How effective are they in protecting the association? Adam?
Well, that's a great question. I mean, waivers are always good to have. Certainly, if someone's coming to volunteer to help clean up the flowers in the median, or you've got uh, folks coming to summer camps at your clubhouse, having parents and participants and volunteers sign waivers is always a very good practice. Typically, I can get a waiver down to about 1 page, so it doesn't require somebody to bring their eyeglasses to volunteer at the pool. But we can generally do it with 1 page. I will tell you though, there's not a single waiver that a lawyer can draft that is 100% bulletproof. There are certainly claims that can be made by folks that sign waivers. You have the fact that minors are not even permitted to waive many of the claims that they might end up making. Certainly their parents can waive those on their behalf, but their parents aren't always around at the time. And the process for having waivers signed certainly leaves something to be desired. Things fall through the cracks. Volunteers are allowed to participate that didn't sign. So there's all kinds of ways that the process of having waivers can fail. And waivers themselves just can't waive every single claim that you can possibly make. But it's a great idea to have it. It certainly shows that the board of directors was thinking about things like risk and the associated liability, that the directors and the officers were doing everything they could from a legal standpoint to limit the liability. And then if you're also making good, solid decisions, getting bids from multiple vendors, looking to not just the cheapest bidder, but also the most qualified, looking for value versus just the deepest discount. If waivers are part of your liability protection plan, they serve a very valuable function, and I would encourage boards of directors to get them whenever possible.
So let's talk about a scenario. I know that we have plenty that we can pull from. Jeremy, with your experience in insurance, and with you, Adam, with the legal side of things. I would expect that you've encountered where the insurance has not been adequate and the association has had to carry a responsibility that could have been avoided with confirming the vendor insurance coverage. So let's say that we have a vendor on property. The association brings with them a vendor, 2 guys and a truck, are the landscapers that they have on property. And while on property, the vendor injures themselves pretty badly to the point maybe they can't work anymore as a result of this injury. Now, the insurance they provided did have general liability, but let's say they didn't have workman's comp. What happens then?
Sure. So that would be a situation where the association could end up being sued under various theories of liability. And it's also a situation where if the association either was tricked into letting them on with a fraudulent insurance certificate, or just simply wanted to use a vendor that was either the lowest cost, or for whatever reason. This would be a particular situation where one of these waivers could come in handy. Having one of these smaller companies sign a waiver that waived the right to make these claims, that acknowledged that the association was not their employer and would not be providing any of these types of coverage, would certainly be helpful. Again, this is a situation though where certain claims simply cannot be legally waived. And so the waiver would just operate to the fullest extent of the law, but might at least discourage those claims from being made. So I think that's a good example of having a waiver in a situation where maybe a vendor didn't check quite all of the boxes that we'd like them to check.
So, Jeremy, so the waiver fails. So let's say that we get here and the waiver fails and we're not able to use the waiver to say we don't have liability. Now what happens? So the association is now exposed. Where do they get
Correct.
this coverage from?
So it's going to start first. If they have a ghost policy workers' comp, that's going to be the first thing because it's a work related incident. After that, then it would fall to the general liability. But again, it would have to be proven that the association was liable to be really under that policy. But depending on the carrier, depending on the adjuster that you have at the day, I mean, it could fall under those two. It wouldn't fall under the directors and officers, but you may have secondary claims like from homeowners or so on if you have to do a special assessment that then file suit against the association where that directors and officers may come into play. But first and foremost, it would come from the workers' comp, and then it would go to general liability. Would be the two places that could possibly protect the association. In that scenario, the workers' comp would be the primary.
Okay, thank you. And so I guess the overall goal here is to shed light on the importance of verifying vendor insurances in the line of doing their duty as a board of director. Now, the management company, Goodwin and Company specifically, we ensure that we take the necessary steps to vet the vendors, make sure that they have adequate insurances. And we do put things in place in case the board does have a vendor that's preferred but may not be able to meet those expectations. But overall, it's important for the board to know and understand consequences for all the decisions that are being made. So if we are able to at least know what we're walking into, the association's better able to prepare. Do you all have anything else to add?
I mean, from an insurance perspective, you're not going to cover everything. So, you can do your best. There are going to be things that may not be covered under insurance. I think you need to look at insurance in a couple of ways. One, don't buy the cheapest insurance, buy the one that is right for you. Okay. Cheap may not always be best. For example, we have some carriers that have really, really cheap directors and officers coverage, but that directors and officers coverage has very high limitations. It does not cover every situation. It does not cover committees. It does not cover a lot of other aspects of most coverages. So you got to be careful. It's what we call an endorsement type policy. Just be careful looking at just price. I know a lot of people think insurance is a place where they can cut cost for the community. I would say you need to look at other places to cut cost. Insurance is the one place I would not necessarily skimp on. There are things too when it comes to, hey, I'm going to have an event there at the community, or I'm going to hire this vendor, or I'm going to do that. If you have any questions, ask your insurance agent. If they're with Goodwin, have them ask me. Like, I don't even insure a property, and they can even ask me. But ask the insurance agent. The agent should, if they're a good agent, give you a quick feedback on, hey, I would do this. I would maybe have a waiver signed or this done, and it gives you next steps when it comes from the insurance perspective. Or, hey, you don't have this type of coverage. If you're going to do that, you might want to add this type of coverage. For example, like Adam was talking about people volunteering to do something. Well, under Texas law, that used to be volunteers were covered under workers' comp policy. That's why everybody had one, was for the volunteer coverage. No longer could be under the workers' comp. So we have a separate volunteer policy that we can get. And that's like $300 a year for up to 100 volunteers at different times. So those are things that we can talk through, that we can go through every situation that you might have come up. But be transparent, be communicating with your insurance agent or insurance carrier, or have your manager do, and that will help educate them and help educate you. I think if you do that, you should protect against most situations. Again, all is not going to be covered.
Well, and piggybacking off what Jeremy's talking about, specifically with respect to insurance and not skimping on coverage or deciding that's the place you're going to save the money. One of the things that I see boards of directors doing that causes me the most concern is failing to get a reserve study done or not following your reserve study. In a lot of instances, we have some real serious downward pressure on assessments. Boards of directors don't like raising assessments. Especially in condominiums. A lot of folks that live in condominiums, especially older condominium buildings, have been there for a long time, and they sought out condominium living for the the reason that they're on a fixed income. And so raising those assessments can be kind of painful. But I would encourage you in discharging your fiduciary duty to the community to have a reserve study done and take it seriously. One of the worst things you can do is to deplete your reserves or to not have sufficient reserves to cover things like insurance deductibles or things not covered by insurance, normal wear and tear. I mean, your roof is going to have a particular useful life. And at the end of that useful life, you should expect to have to repair it at the then current cost of roof repairs, which, as we all know, is going up. So it's very important to put away that money into the reserve account. And it's the financially responsible thing to do. It's the adult thing to do. It's not always going to be very popular in the community. And in fact, it's one of the reasons I see members of the community sharpening up the pitchforks and lighting up the torches to come to the next board meeting and be very upset. But armed with a reserve study, you can explain why we have to do this assessment increase, and it's going to protect all of our largest investments if we do it. And armed with that information, most people can see the light. But that's one of your responsibilities as a board member, is to keep the assessments set at a level that allows you to undertake all of the obligations that you have, even if it might be a little bit painful for some of the residents. So that's the biggest advice that I could give.
And I would say the reserve study too also is very helpful on the insurance thing. It gives us a lot of information, such as age of roof. It gives us replacement cost of a lot of items. So it will help you, it can help mitigate costs on things that are overinsured or underinsured. It could also help at times of loss that we have the information, for example, like the age of roofs. Insurance carriers are really focusing on those age of roofs. And so those are some things that we need the information on. And if you don't have a reserve study, it may be guesswork for some people. Hey, I'm new to the board. I don't know when the roof was last replaced. That's a big question that is asked with insurance that could cost you or save you money in the long term. And so that's something that may be useful for you down the road.
And one last thing, have that reserve study updated. As we talked about earlier, the insurance market has changed over the last few years. And if you had a reserve study done that was based on the deductible that you had 3 or 4 years ago, and your deductible has changed, it might be a good idea to go back to that reserve setting company and have them give you a quick update on what you should do now that either your coverage or your deductibles have changed.
Thank you so much, gentlemen. And just to kind of connect everything, the exposure created by inadequate insurance with a vendor creates a scenario where there are more opportunities for additional claims, more losses by the association, and that will impact your insurance costs because, like Jeremy mentioned before, the increase in claims in Texas and Colorado have directly impacted the increase in costs in insurance coverages. Am I correct, Jeremy?
Correct.
And so it starts with these small steps to ensure that the association is controlling and limiting their exposures. I want to thank you both for your time today and your expertise here. And we look forward to another workshop with you in the future.
Looking forward to it.
Thanks so much, Fancy.
Thank you.